Hi, welcome back to another episode of Wilkin & Gutton Plans, the Balance Sheet Breakdown. This is week 3 of our 4-week program where we're talking through some of the metrics that impact profitability of professional service firms. Today we're going to be talking about margins and maybe overall gross and net profitability. I'm Chris Frederick, a partner with the firm, and joining me again for this conversation is Karen Artazanchez, the leader of our firm's professional services practice group. So Karen, thanks for joining again.
Thank you for having me. I can't believe we're 3 weeks in already.
I know, it's
crazy.
Time goes
It's been
quick.
fun.
Right, exactly. And so far we've covered maybe 2 more mathematical calculations. That being utilization, which is the allocation between billable and non-billable time, and realization, which is how much of that standard billing rate is actually being pushed through
And converted to cash.
And converted to cash and invoices.
Yep.
So Karen, I know last week we kind of alluded to a few of the things we're talking about this week. Just how realization and utilization kind of impact that top line, and I think today we're going to be looking at what impacts the top line, but maybe what also falls to the bottom line, and how that all kind of flows together. So, what are your thoughts as we get started?
Chris, before we get into the details, I think it's worth it to define some of the terms that we're using. We throw around, accountants speak like everybody in the world understands it. And I just want to make sure that, the words that we're saying resonate, with our listeners. So when we talk about top line, we're really referring to the revenue or fees generated, and billed. When we talk about bottom line, we're really referring to the what's left after all expenses are paid, and margin typically is defined in terms of a percentage, which is computed based on your net income or your bottom line as a percentage of your top line. The higher the margin, logic would dictate the higher the margin, the more profitable a firm is.
To me, understanding the bottom line is really understanding the inputs, and the inputs really start with top gross revenue.
Right, yeah. Your top line gross revenues is based on how much cash we collect, right? The cash that we collect, whether it's today or tomorrow, in terms of converting your accounts receivable to cash, that's the cash that's available to pay our expenses, salaries, overhead, so on and so forth.
Invest in the future, whatever.
Right.
Yep.
And tying our discussion, last week, relative to standard billing rates, right? When we want to understand margin and profitability, we really need to understand what's driving that bottom line. We all know what drives the top line, right? But what really moves the needle on the bottom line? Going back to the whole idea of capturing data in our internal, practice management systems at a standard rate. Consistently, right. Consistent data. There's the broken record.
Right.
Gives us visibility into the areas of the firm, practice areas, even clients, like going down, to the client level, that we need to focus some, good or bad attention on, whatever the case may be.
At that point, right, with the standardization, it allows you to start really seeing what that realization is to give you an idea of what clients are providing, maybe that higher margin, higher hourly collected rates.
Right.
To me, that's probably maybe one of the key important takeaways of what we're talking about. I mean, and I think it sounds maybe more complicated than it needs to be.
It definitely does sound more complicated than it needs to be. I mean, really, what we're looking to do is just, again, use our data to highlight the areas where we make more money, right? Because
that move the needle.
And again, I know I mentioned this last week. Profitability means different things to different people, right? And I think we're going to talk about that a little later. But the goal of a professional service firm should not be to achieve 100% realization.
Right. It seems unlikely that every single client you have, you're able to bill exactly what your standard rates are.
And if you are, chances are you're leaving money on the table, right? So you're going to have some clients that, you can bill more than your standard hourly rate because the time that you spend, what you're doing is worth more. Our expertise,
whatever it may be.
Exactly. And then there's others that you may not. You may have to take a haircut. So average, I think, again, everybody's different across the industry, but, somewhere between 80 and 90% should probably be a
Yeah.
realistic target realization to achieve
Well, and
firm-wide.
I think it's something you touched on last week, right? When we talked about maybe some of the internal efficiencies that we were able to identify, right? It's hey, our clients aren't going to pay our standard rates for this service.
Correct.
So what can we do internally to allow us to still provide that high quality client service at a point that makes sense to us from that top line?
Right, and that's really, again, goes into understanding, efforts and what we're doing and how those efforts fall all the way to the bottom line. Like how much is left for us to make decisions with. So when we talked about utilization, the first week, we talked about understanding the relationship between billable and non-billable initiatives, right? Hypothetically speaking, using standard rates, achieving strong realization, coupled with a high level of utilization, right, should really equate to significant margin. On the other hand, if you have really strong top-line revenue with good realization, but it doesn't seem to have, the effect on the bottom line as you would hope, you don't have enough, we should be making more money,
Yeah.
Like that type of realization, that should be some sign or an indication that you may need to increase your standard rates, right? Salaries go up, right? We talked last week about what goes into a standard billing rate, and everybody, across the country has experienced, increases in salaries. So the cost to employ people has gone up. That,
Right. It has to be reflected
in our billing
and
rates.
pass through or the
Right. So again, it's either an indication that, standard rates need to increase, to cover overhead expenses. Rates really should be revisited every year, right? Because salaries are increasing
Right.
every year. Overhead costs.
Well, I would say
are
it's not just
increasing every
salaries,
year.
right? Because to your point, there's a lot more than just covering salaries. I mean,
Yep.
thinking about most professional practices, while salaries may be the biggest driver of it, it's far from the only one. There's plenty of other overhead, indirect costs, technology costs,
Right.
That really add up.
In a professional services firm, salaries are going to be one of the biggest expenses.
Right. That's the asset. That's
correct.
What's being transacted through the
Yep.
hourly rate to our work.
You mentioned technology. That's another huge cost, especially in this day and age.
Yeah.
But in terms of measuring profitability and margin, we need to consider all overhead costs: the technology costs, rent, insurance, software, client acquisition costs.
Right. Or like even outside of client work.
Right.
It's all those really indirect, the marketing teams, the HR teams, that what it takes to keep an
To get and
organization
keep
running.
client, right? And I think my experience in dealing with professional service firms is like client acquisition cost is almost like a foreign concept. So I think it's worth a couple of minutes here just to kind of talk about that.
For sure, and I think that's a fantastic point. That it means a lot of different things to a lot of different people. When you think of client acquisition costs, what do they maybe mean to you?
I generally think about three things, right? You have advertising costs, easily quantifiable, but again, what does the data tell you? Are you advertising in the right places? Do you have anybody designated to really measure, the return on investment? So we're sending those dollars out
to the
out
third
the door,
parties and
right?
Yep.
If you have, I'm going to make something up, an elder law practice, and you're advertising
Various publications and whatever it may be.
that that aren't
Yeah.
distributed,
Yeah.
Does that really make sense? Is that a good use of those advertising dollars? Second thing I think about when we talk about client acquisition costs is business development. And when we spoke, I guess it was the first week, on utilization, right? To go out and do business development, that's not directly related to the top line. That's one of those, what I call value added, non-billable activities. And we mentioned a couple of weeks ago that not everybody is a rainmaker. Not everybody can be a rainmaker. Not everybody should be a rainmaker. So you want to make sure, that if everybody's out doing business development, who are those, individuals that are really good at it? And should they be, designating more of their
Right.
time? So again, measuring the return on investment of the time that's spent. And third is like your website. It's computer software. The minute you generate it, it's outdated. Right? So
It's always living and breathing.
right. It's costly to maintain, but is it current? Are you doing anything, really to measure driving traffic or who's monitoring all of that. And those are, those three things can be high dollar, expenses that contribute nothing directly to the top line, but impact the bottom line.
At least I've seen when it comes to if we maybe focus on just the marketing aspects, right? It's those outsourced independent third-party marketers and having some of our internal folks do some of that work. I think I've seen many professional service firms be able to really effectively assess what the return on those dollars are when they're paying a third party, right? I mean, because typically it's service contracts, part of the deal is what leads they're getting, who you're getting in front of, and so I think those are usually pretty stringently maintained. But to your point about utilization and allowing some of our internal folks to do some of that non-chargeable work without tracking that non-chargeable time and really understanding what the fruits are. Yeah, listen, I understand it's not a gross margin type of activity,
right?
But to your point, that could be of much greater value than that third-party firm you're comfortable writing that check to every month. But without the data and understanding the outputs and the inputs, it's hard to make that determination.
Right, and I think one of the things that we all get lost in when we're those of us that work in professional service firms, we're good at what we do, right? And sometimes we forget, particularly as business owners, that we have to run our business, not just that slice of the business. So I'm on the tax side, right? So I'm good at doing tax things, right? But I also have to be mindful of how what I do impacts the overall profitability. And I think that's again, in my experience, what I've noticed, trending through professional service firms is that we do what we know and just kind of hope, right, that what worked yesterday is going to work today. Understanding the people and how they contribute and, what really impacts the bottom line. It's easy. It's a very easy thing to say we have to cut costs. Question is, what costs do we cut? And how do we determine what costs we have to cut? And that's where I'm going to say it again. The data is important, and understanding, what you've said several times, the inputs that are generating the output. I think all professional service firms need to really spend more time understanding the data that they have or could have with some tweaks. For sure.
And we talk about utilization, realization, which obviously gives you great data into what your W-2 employees are doing, so to speak. And I think you mentioned it with some of those other maybe below the line, those operating expenses, understanding what those are. It works the same way, right? Understanding what the output is for the dollars you're putting in.
And I want to end with this, one last thought, and I kind of mentioned it a little earlier. Really understanding what profitability means. It's not just one thing, right? To you, profitability could mean I want more money in my pocket at the end of the year. To me, profitability could mean something completely different, right? It's a higher top line revenue. So it really depends.
Right, to set up for future growth. So maybe there is some downtime of being felt by people because we're going to be set up for huge success next year. So so I think that's a great point, and I think that's a maybe a great spot to wrap it up. Is that it really is a one size fits one.
Yep.
And what works for me might not work for you. What works for my service line might not work for your service line. That it's really important to understand all the inputs, all the outputs.
Yep.
So Karen, I think we'll wrap it up there. Thanks for joining. I think we have one episode left where we're going to talk about leverage and accountability, the idea of Habula. And so I'm excited for that conversation next week. And so for now, this has been Chris Frederick of Wilkin & Gut & Plans Balance Sheet Breakdown, helping you make sense of the numbers.